performance measurement and evaluation of portfolio managers. So you will see a lot of ways of measuring performance with respect to what are the different return methodologies, calculations of those, many types of risk ratios. So apparently Tejas asked one of the questions with respect to trainer ratio, which I will be covering in this session. So just wanted to check कितने लोगों को पता है. So good, some people knew about it. So makes the job easier, but ठीक है. For others, we'll cover in this session. So coming back to chapter 10. So rate of return measures. So there are a lot of measures in with respect to how you can measure returns. One of the basic methodology is holding period return. Now, holding period return is a very, very simplistic way of measuring returns, wherein you know the initial amount that you invested, you know the final value of the investment. It could be any period that you're holding that investment for, maybe 6 months, maybe 1 year, maybe 5 years. You're just trying to calculate the return that the asset has created in that particular period. So it's a simplistic absolute return that has been generated. So if you have invested 1 lakh rupees, if the final amount is 1,20,000 rupees, which means you have created a 20,000 worth of extra value on that 1 lakh rupees, so which is 20% return. In that interim period, if there has been an income flow, let's say a dividend of another 5,000 rupees, which makes the total income generated or total return in that period from 20 instead of 20,000 to 25,000 now, with this 5,000 of extra dividend that has come in, 25,000 divided by 1 lakh will give you a 25% number. So this is a simplistic absolute return that the asset would have created in that holding period. It does not annualize the returns. It is a simple absolute number. The formula, as you can see, is income plus the ending value minus the beginning value divided by the beginning value, which is what I did. 20,000 plus 5,000 divided by 1 lakh rupees. The next is the arithmetic and geometric mean, a little ahead of holding period return. Now, let's assume what arithmetic mean does is it is a simple average of all the period returns or primarily the yearly returns. So let's say in the first year, the returns are minus 50%. Second year, the returns are 100%. Arithmetic mean will just take the sum of the two, which is 50% divided by 2 will give you a 25% return. But if you actually think, if you have invested 100 rupees and in the first year that is down by 50%, that 100 becomes 50. In the second year, if that 50 is up 100%, which means another 50 is created on that 50, so which is 100. So 100 becomes 100 in 2 years. Primarily, there is zero return from an investor's perspective, but arithmetic return will give you a number of 25%. So it's not very, very useful, and hence you will not find it getting used also. But I have seen people, I mean, if there are 6 monthly returns given, people just add and do a average of the same, which doesn't really make sense. But as long as they are in the same direction, maybe it will give you an idea. But if they are in opposite directions, it will not make sense. So arithmetic return is not a very, very great tool in terms of analyzing returns. Similarly, a second example which we have put over here is, if let's say 2 years are generating a 10% return, the arithmetic return is also 10%. Now, just to compare two portfolios basis the arithmetic return methodology. Now, these are questions that can come as a part of the case study or maybe independent questions also. But let's say if there are two portfolios that generate returns as per AMR1 and AMR2, now it might seem that 1 year, I mean, the first example has minus 50%, but it has a 100% number. And second example has just a 10% number in both the years. But apparently the 10% return will actually generate a better return for the investor in spite of AMR2 being lower than AMR1, because 100 becomes 110 and 110 becomes 121. So arithmetic mean will not give you the answer, but apparently the portfolio 2 will generate better returns as compared to portfolio 1. So geometric mean is a better tool to compare portfolios. What it typically does is it multiplies all the periodic returns and gives you the final number. So in this case, this is the calculation which I already did for you. So GMR1 for the minus 50% and 100% portfolio returns, the GMR1 is 0. So actually investor gets 0 because 100 becomes 50 and 50 again becomes 100, while GMR2 becomes 121, which on an annualized basis is 10% returns. So GMR2 will indirectly tell you that this portfolio is a better investment portfolio for an investor. I mean, we are not coming to the risk ratios in terms of who is more volatile and not. That will also indirectly tell you that, I mean, even from that perspective, you will know that GMR2 or the second portfolio is a better portfolio for an investor. But nonetheless, from a basic return perspective, a GMR is a better measure as compared to the arithmetic return mechanism. Then coming to the core of what typically happens with investors is investors will calculate their returns basis the IRR methodology on Excel, and then they will see our returns basis TWRR, because SEBI mandates us to use a TWRR methodology. And if there are inflows or outflows, the numbers will be different. And investors say, "Ki yaar, aapka number is not correct." But these are two different methodologies of calculating return, and hence the differentiation. Starting with MWRR, what MWRR does is basically MWRR is an annual rate of return at which a cumulative contributions grow over the measured period. So it is dependent upon those contributions, and hence it depends on the timing of the cash flow. So just to take an example, if there's a 5-year period and these are the holding period returns for those 5 years, and these are the contributions that the investors has done at the beginning of each year. Now it is at the beginning of each year because only then that 5,000 will have that return of -5% in the first year. So if you just cumulate the contributions, it's a 75,000 rupees that has been invested by the investor in a period of 5 years. Now, if you were to calculate the final ending value of this investment for the investor, I mean, I'll just take you through the first two rows. 5,000 rupees at a -5% sort of a return in the first year means that 250 rupees was a loss in that particular year, or the initial value was 5,000 and the ending value was 4,750, which is what the first row says in the last table, the table below. Similarly, 2016, since you already had a 4,750 number, plus you added another 10,000 to your kitty, the initial value is 14,750, on which there was a negative return of 15.2%, which means you lost 2,242 rupees, and hence the ending value is 12,508, and so on. If you do for the next 3 years, the final ending value comes to 1,05,920 rupees. Now, what MWRR does is, now you know the inflows, the returns were calculated basis the holding, basis the beginning value of that particular year, and hence it is considering the inflows of that particular year, and hence the returns or the final value is basis the contributions made by the investor. And MWRR will calculate what will be the common rate of return that you apply for all these inflows to get that value of 1,05,920 at the end of the 5 years. So MWRR is basically more like an IRR. I will also tell you what is IRR and what is XIRR. That is not covered in the syllabus, but I'm sure everybody who is using Excel will know this. But basically MWRR is IRR, the internal rate of return, a common rate at which you will have to discount all the future cash flows to come to the present value of 5,000 rupees. And if you apply this in Excel, typically we don't do it manually. Nobody expects you to do it manually either. But if you apply an IRR formula in the Excel, which is basically capturing all the values, the inflows are generally negative, outflows are positive. If you put that in an Excel IRR function, you will get a 15.15% IRR. Now, how IRR differs from XIRR is, IRR assumes that all the periods are equidistant from one another. So like in this example, all periods, all inflows happen at the beginning of the new year. So these are equidistant periods. However, not necessary. Actually, the periods are equidistant, and hence the XIRR function of the Excel ensures that you also capture the dates and with that the values, and hence you get the correct internal rate of return considering that the time interval between the two periods is not uniform. So that's only the difference between XIRR and IRR. In IRR formula in an Excel, you need not consider the dates. In XIRR, you have to select the dates column. So I mean, this is just a repeat. XIRR is an annual rate of return at which the cumulative contributions grow over a measurement period. MWRR on the depends on the timing of the cash flows. And I'll just prove you with with another example. So keeping the same rate of returns for those 5-year period and just interchanging the inflows that would have been received in those 5 years. If we reverse the inflows, the total contribution of investor remains at 75,000 rupees. If you see, the yearly returns also remain the same. However, the final value changes from what was 1,09,000 odd to 1,07,900 rupees, which means that this methodology, since we are since the let's say in the second row, the 43,750 is the opening value in that year, and on that you apply the rate of return of that year. So basically inflows are governing the returns, and hence the returns are based on the inflows and outflows that an investor may have. So from an investor perspective, XIRR or IRR makes sense because ultimately it is that return that he's generating. Just taking a very, very simplistic example, let's say, and taking the first example that we discussed during the arithmetic mean example, let's say the investor, just reversing it, let's say investor invests 100 rupees in the first year and his returns is, I'm just creating an example. Let's say the returns is 100%. So his money grows to, from 100, it becomes, or let's say it's a 50% return that he generates. So in the first year, his money becomes 150 rupees because 100 grows by 50 rupees. So his total at the end of the year is 150. In the second year, let's say he invests another 100 rupees, which means his opening corpus for the second year becomes 250 rupees. And in that year, let's say the markets crash by 50% again. So first year 50% positive, second year 50% negative, which means 250 rupees becomes negative by 50 rupees. At the end of the year, he has 125 rupees. Now for an investor, his total contributions were 100 rupees in the first year and 100 rupees in the second year. So he has contributed 200 rupees. The final value is 125. So he has had a total loss, absolute loss of 75 rupees, or a CAGR somewhere in the range of 30 to 35%. I am not calculating on Excel, but average of 75 is 37.5. So somewhere 33-34% will be the CAGR loss that he would have had in those 2 years. But if you think of it from a fund manager's perspective, ultimately the decision of he investing 100 rupees in the first year and not 200 rupees at one go, and in the second year he invested 100 rupees, was a call by the investor and not governed by the fund manager. So if I were to look at it from the fund manager's perspective, and typically you have seen this happening on the mutual fund side, ultimately when the fund manager grew the money by 50% in the first year, a base NAV of let's say 10 rupees becomes 15 rupees at the end of the first year, which is a net adjusted value, the NAV of that portfolio. So 10 rupees becomes 15 rupees. Now, irrespective of the inflow in the second year had a negative return of 50%, which means your 15 rupees NAV gumps down by 15% or becomes 7.5 rupees. So over the complete tenure of the portfolio, 10 rupee NAV became 7.5 rupee NAV, which is a 25% loss over a 2-year period, or maybe a 11 or a 12% CAGR loss, as against for an investor who is looking at it as a 33% CAGR loss. So there is a difference in both the methodologies. Both are correct. One is more looking at investor's loss because ultimately his 200 rupees become 125. But for a fund manager, the NAV came down from 10 rupees to 7.5 rupees because the second year inflow was governed by the investor and not the fund manager. So he shouldn't be penalized for what the decision that the investor took to add in money. Because had the investor invested the entire 200 rupees in the first period, his 200 would have become grown by 50%, which is 300, and 300 might have come down to 150 rupees, which is basically the 25% loss or a 12.5% CAGR. So ultimately, the inflow outflow is something which is more relevant for an investor, but fund manager is more looking at what has he done for that year, and hence For the fund manager, it's a TWRR. So the second calculation methodology I just did verbally was the time weighted rate of return. It depends upon in that particular time what was the return that the fund manager was able to derive, and hence SEBI mandates that all fund managers should calculate their returns basis the TWRR methodology. So coming to TWRR, as I said, in order to calculate the underlying investments performance without being influenced by the timing of the cash flow, TWRR can be calculated. And GIPS, which is a global investment performance standards as made by the CFA Institute, they define TWRR as a calculation that computes period by period returns on an investment and removes the effect of the external cash flows. So what we did was, we took the 10 rupee NAV, we took the first year returns, which is 50%, and hence made it 15. And then we took the second year returns, and that 15 became 7.5. We did not consider what is the actual amount that came in at 10 rupees NAV, and hence what is the unit and what will be the actual value of the investment. In TWRR, portfolio will be valued every time there is an external cash flow. If there is no external cash flow, TWRR is equivalent to the holding period return. As I said, 10 becomes 7.5, so it's a 25% loss, which is similar to what we did in HPR. You annualize it and it becomes similar to the arithmetic mean. So just as an example, that is a detailed example per se from a TWRR perspective. So 5,000 rupees with the same rate of return methodology. So what TWRR does is, it basically does not compute the returns per period in terms of the starting value and the ending value. What it does is, it calculates a relative, a wealth relative, which means that 1 rupee, if it is at a 5% loss, which means you lost 0.05 rupees or 5 paise basically, which means on a base of 1, the wealth relative is 0.95, or basically in our example, on a base of 10, the wealth relative was 15 with a first year returns of 50%. So this is exactly what this is doing. This is on a base of 1. I was doing it on a base of 10. Similarly, you do it for each year, and then you multiply all these wealth relatives. What you get is a cumulative wealth relative that a fund would have created. You minus 1 because that is your initial base value. And what you get is the returns that the investor would have created in that period, and you annualize it, you get a TWRR at an annualized rate, or the CAGR value of that. So cumulative wealth, basically the first blue one is basically where you multiply all the wealth relatives and you get a value of 1.3396. The cumulative wealth relative tells us what 1 rupee would have grown to in that particular time period without any inflows and outflows. Now, if you want to find out the CAGR for this, it basically utilizes a formula of future value is equal to present value into 1 plus R upon the rate of return upon 100 raised to M. And then you find a rate of return methodology, which is basically 1.3396, which is the number over here, raised to 1 upon 5, which is the period, minus 1. So that will give you the TWRR value at a annualized basis. So as I said, TWRR at a CAGR level is very, very equivalent to the geometric return. Rate of return, a few other rate of return measures. So TWRR, MWRR is the core of the chapter, which is where you will actually find most of the questions, because from an investor's perspective, as I said, MWRR makes sense, but from a fund manager's perspective, it is a TWRR that makes sense. Other things that you need to consider when you are comparing returns of two portfolios is whether you are comparing gross returns versus net returns. I'm sure everybody is aware of what gross returns is, which is without considering all the charges that would have been applied, while net returns is net of fees and expenses. Another criteria for evaluating returns could be pre-tax returns and post-tax returns. Post-tax returns is basically pre-tax returns into 1 minus the tax rate. So if 33% is the tax rate, ultimately investor gets only 66%, and which is what this methodology is doing. Also, typically you talk of CAGR returns, which is basically analyzing your returns. Another thing that sometimes, I mean, not something that is done right now, but what used to be followed was people used to only report, let's say out of 100 rupees, 90 rupees is invested into equities, and equities give 10% return. They used to say 10% is a return. But ultimately, there was a 10% cash allocation which did not generate that 90%, that 10% return. And hence, the return should be at a portfolio level. So 90 became 99 plus 10 is 109. So returns is not 10% plus 9, but 9%. Plus whatever would be the cash returns. I'm assuming 10% in cash remains 10%. But basically, the return should be adjusted for the cash drag in the portfolio and should not be just basis the equity allocation in the portfolio. The next big terminologies that will be discussed in detail in this chapter is the alpha and beta return. Now, somebody asked a question in the first session. I don't recollect what, but whether that is systematic or unsystematic. And I think so it was with respect to distressed securities. However, that can have both the components, because ultimately risks, both these risks are always present. One risk is more which is common to the system's impacts of, let's say, an interest rate at an economy level will have an impact on all the sectors which are relevant in the economy. So if you are an India-centric fund, the interest rate scenario or the overall GDP level sort of news will have, I mean, those that impact on the portfolio returns are something which are systemic risk and which are something that you cannot diversify if you are only investing into India portfolio. While if you have a portfolio which is, let's say, if you have a banking stock and you want to diversify that banking related risk, you can maybe buy a cement company or a IT company and diversify that sort of risk, and hence that is called as unsystematic risk. Now, again, this is upon how you look at the portfolio. If you are a sectoral portfolio, even that sectoral risk will become a systematic component risk, because again, that is the risk that you cannot diversify in a sectoral portfolio. So it's not that if you are investing into a banking stock, the banking risk is systematic or non-systematic. It depends upon your investment approach ultimately. Now, coming to alpha and coming to systematic risks and non-systematic risks, I have in a way defined this. So systematic risk is risk due to common risk factors like interest rates, exchange rates, commodity prices. It is linked to the overall demand and supply in the marketplaces. All investments will get affected by these common risk factors directly or indirectly, like the interest rate risk. If the government is or the government of India or the Reserve Bank of India is expected to increase rates or decrease rates, it might directly impact the banking sector, but it also has an impact on the automobile sector. So it can be direct or indirect, but these are risks which are at a economy level, at a common level for all the constituents of the portfolio, and hence non-diversifiable. Systematic risks cannot be diversified away, though it can be hedged. Now, hedging is a separate aspect, but you can't diversify that risk. You can take a anti-call to it and hedge it through maybe another instrument, but you can't diversify it. Systematic risk is measured by beta. Beta is basically, if we are comparing our portfolio with the benchmark, more or less the portfolio will include constituents which are a part of the benchmark, and hence how much the benchmark correlates with the portfolio is what is determined by the beta. A beta relates to the return of a stock or a portfolio to the return on the market index. It reflects the sensitivity of the fund's return to the fluctuations in the market return. Beta of the portfolio can also be calculated by taking the weighted average beta of the individual security. So if you have two portfolios or two funds, they have individual beta. The portfolio beta is basically the weighted average of the individual betas and the weight of that particular instrument. A beta greater than 1 means that the portfolio is more volatile as compared to the benchmark portfolio or the market portfolio. Unsystematic risk, coming to the unsystematic risk, these are the risks which are company specific or sector specific, and hence you can diversify by getting into multiple companies or multiple sectors. As I said, again, this needs to be looked upon from a overall portfolio investment approach perspective. If it's a sectoral portfolio, the sectoral risk cannot be diversified. You can only maybe get into multiple companies to reduce it, but still, if there is an interest rate risk that applies to the banking sector, and if you are a banking mutual fund, then that becomes a systematic risk in this particular example. But more or less, if it's a multi-cap fund, if it's a flexi-cap fund or a normal mutual fund, sectoral risk is something that is assumed to be diversifiable because you can get into other sectors, and hence they are something that can be diversified away. Alpha is something that captures the unsystematic risk of the portfolio, and hence more or less the fund manager ultimately is I mean you judge the role of the fund manager with the alpha that he is creating. Tracking error is basically I mean it's a standard deviation of the difference between the portfolio and its target benchmark portfolio return. So that's a tracking error part. We'll come to it a little in detail when we come to ratios and all. So this just to give you an example. So let's say if the portfolio return is 25%, let's say the benchmark return is 15%, and if the beta is 1.5. Now beta is 1.5, which means that you are taking a little higher risk as compared to the benchmark, and more or less your portfolio gives 1.5%, 1.5 times return as compared to the benchmark return, or you get 1.5 times more returns as compared to the benchmark return. So if I were to calculate with respect to how much is the alpha that the fund manager has created, now typically, as I said, for a benchmark of 15%, the beta return is itself 1.5 times the excess return that has been created over the benchmark. Now benchmark is at 15%, the risk-free rate is at 5%, which means the benchmark is creating an extra return of 10% over the risk-free rate in the market. Now this risk-free, this additional return that a benchmark is generating is something that you multiply with the beta of the portfolio to get the beta return of the portfolio. So if you see beta return is beta into the market, into the benchmark return minus the risk-free rate return, which gives you 1.5 into 10%, which is 15%. Now, whatever is that additional return, any which ways you will get the risk-free rate return, which is 5%. So 5% plus 15% is what anybody would have got by taking that amount of higher risk as compared to the markets, or as compared to the benchmark, which is basically the 20% return. Now, if the actual portfolio return is 25%, which means by a proper stock selection or a proper sectoral selection, the additional return that a fund manager has created, which is 5% in this example, is because of the fund manager, and that is generally referred to as Jensen's alpha. Now, many times people just minus the two, which is 25 minus 10, and say 10% is alpha, which is a very, very simplistic way of referring alpha. Alpha is generally the Jensen's alpha, which utilizes the CAPM formula, which is the capital asset pricing model, and which determines what is the excess return the portfolio manager has been able to determine apart from the beta return, which is because of taking a higher risk on the portfolio as well as a risk-free return in the market. So that's more or less what is alpha return. Alpha return is a reward for bearing the non-market risk, as I said. Beta return is a reward for bearing the market risk. I have already mentioned with respect to how sometimes people use the generic alpha terminology. A few other things on the risk measurement. Portfolio return. The return of the portfolio is basically the weighted average return of all the individual securities in the portfolio. And this concept is also utilized ahead in the Modigliani, which is the M square methodology of risk calculation. But if you have multiple funds that you have invested into, and each has a return, and there is a weightage that you have assigned to each portfolio, the overall portfolio return is a simplistically weighted average of all the individual securities. Risks can be measured in two ways. One is the total risks. I mean, we talk of standard deviation, for example. Now, standard deviation measures how much the portfolio returns vary over a mean. So if this is a mean, how much it goes up and how much it goes down, or in what probability will you be able to determine the returns of the portfolio up or down the mean of the portfolio return. While sometimes there are terminologies of I mean, ultimately, if this is the mean, let's say 0 is the mean, and this is the upside is a positive returns that a fund manager generates, the downside is a negative returns that a fund manager generates. Now, nobody wants to actually see the upside as a risk part, because instead of a let's say 0% return, if the manager, or let's say the mean is at 10%, now instead of 10%, if the manager is generating a 15% return, that is good for the portfolio. The concern is if there is a negative, if there is a return which is under the mean, and hence people many times talk of the downside risk, which only measures the worst outcomes of the returns per se. Standard deviation is something that calculates the total risk of a portfolio. Standard deviation basically is all about calculating the dispersion around the mean of the portfolio return. So if let's say the monthly standard deviation is 3.27%, just as an example, and the expected return, the mean return is 2%, it means that 66.7% times, or a 66.7% probability that the return of the portfolio will lie between 1 sigma, or basically 2% plus 3.25% and 2% minus 3.25%. So between a range of 5.27% on the upside and minus 1 to 1.25% on the downside, within that range, 66.7% of the time the returns will be in this range. That's what standard deviation will tell you. How much is the volatility in terms of the returns of the portfolio? Similarly, 95% probability that the portfolio returns will be between 2 sigma standard deviations, or basically 2% plus 6.54%, which is 2 times 3.27%, which is the standard deviation, and similarly on the negative side, and a 99% probability that the returns will be between 3 sigma standard deviations. That's what standard deviations as a measure tell you. I mean, many times you have seen that bell curve and a chart, there's a mountain type picture, which tells you that if this is the mean, how much it is on the negative side and how much it is on the positive side. A semi-variance is basically what calculates the downside risk, which is only one side, not much popular, but you will see a few ratios that consider only the downside deviation. This is the formula for standard deviation and variance. I'm sure, I assume that typically you will not find a test requiring you to calculate this on paper. Risk adjusted returns, one of the famous tools that is used to calculate the risk adjusted measures is Sharpe ratio. Sharpe ratio, what typically it does is it captures a portfolio's excess return for every portfolio's return in excess of the risk-free return, and it divides the excess return by the portfolio standard deviation. So for every extra risk that you are taking for the portfolio, what is the excess return that you are able to generate on that particular portfolio is what the Sharpe ratio tells you. A little different is a Trainer ratio, which will calculate the excess return, but the denominator in this case is not the standard deviation, but it is a beta of the portfolio. So for every extra risk that you are taking in the market, what is the extra return that you are generating in the portfolio is what the Trainer ratio captures. As I said, the denominator is replaced with beta. In contrast to this, a Sortino ratio is very similar to a Sharpe ratio. As I had said, the numerator is the same, which is your excess return over the risk-free rate. So whatever is the benchmark, whatever is the portfolio return minus the minus the risk-free rate is what the numerator is for Sharpe ratio as well as Sortino ratio. But the Sortino ratio only takes the downside deviation as a denominator, while the standard deviation is used as a denominator for the Sharpe ratio. So if I were to see the formulas, the Sharpe ratio, as I said, is return of the portfolio minus return of the risk-free rate divided by the standard deviation. So for every extra risks that you are taking in terms of the dispersion from the mean, what is the extra return is what the Sharpe ratio does, while the Sortino ratio does the same thing, but only considers the downside risk of the portfolio deviation or the dispersion only on the downside. The Trainer ratio has the same numerator, but replaces the denominator with the beta of the portfolio. So it is more with respect to the extra market risk that you are taking in the portfolio. Information ratio is one of the very standard tools that are used to determine how well the fund manager has been using. So somewhere it tells you how good the fund manager is. It determines whether or not an observed alpha is due to skill or chance. And we can compute the information ratio basis the formula of whatever is the excess return over the benchmark, which is the simplistic alpha methodology, divided by the standard deviation of the portfolio returns and the benchmark returns, which is also known as a tracking error or the active ratio. Also, I mean, these are different terminologies used for the same number. So numerator is a ratio in the ratio represents a fund manager's ability to use his skill and information to generate a portfolio return that differs from the benchmark against which his performance is being measured. And the numerator is also known as an active return on the portfolio. People sometimes refer to it as alpha, but actually alpha is the Jensen's alpha, which I said earlier. The denominator here measures the amount of residual risk that an investor incurred in pursuit of those excess returns. And that's why the standard deviation of the portfolio returns minus the benchmark returns is what is used, which is also known as a tracking error. The last of the measures is the Modi-Giuliani measure, which is the M square. Now, what they did was they just adjusted the risks of the portfolio to get the market risk per se. So I'll just explain you with an example. So suppose the portfolio has generated a return of 35% and a market, which is a benchmark portfolio, has generated a return of 28%. Now the treasury bill is at 6%. Now imagine it's like saying that there you have two options. One is a government securities, which is a risk-free portfolio, and the overall portfolio, which is the market portfolio or the benchmark portfolio. How should you split your monies to get the final return that the portfolio would have actually generated? Now, the standard deviation of the portfolio here is 42%, while the standard deviation of the market portfolio is 30%. So what it means is, if I were to deploy in two portfolios and I were to ensure that the overall investment has the same risk as compared to the market, I will have to bring the standard deviation of the portfolio to not 42% but to 30%. Now, how do I bring that investors portfolios standard deviation to 30%? Rather than investing 100% of the money, I only deploy a percentage, which is basically 30 upon 42 or 0.71 or 71.4% is what I deploy into the portfolio, which is a portfolio of the fund manager, and the rest of the money I deploy in the risk-free rate. So at a weighted average level, the portfolio comes down to the actual deviation of the of the portfolio. And in that scenario, what will be the return that the investor would have got? So in this case, if 71.4% of the money would have gone into the fund manager's portfolio, and the rest of the money would have gone in the risk-free rate, and if I were to calculate the returns that the investor would have got, it comes to 26.7%. Indirectly, it says that since the return on the hypothetical portfolio that we created by splitting the monies is less than the market by 1.3%, because the market return is 28%, which means the portfolio manager has underperformed than the market. So this just ensures that you split the money to adjust the volatility with respect to the benchmark, and in that volatility, what would the fund manager would have delivered. And if it is lesser, that means the portfolio manager is underperformed as compared to the market. So it is basically comparing the risks that the fund manager is taking to create that sort of a return for the investor.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.